Hello again, and welcome to the anti-bubble report. We're moving on to the next section where we're going to be discussing relative value across volatility and inflation hedges. And starting with the summary table from the previous section, we see that the strategy currently has about 19.3% of its capital invested in options, which are spread out through different times, but also through different underlines and payoffs. We saw how obviously vanilla options are always favorable, which are a very clean play on volatility and direction, but often these are expensive, and that's why we also use more exotic and hybrid options, which take advantage of things like skew or correlation. So it's critical here to understand volatility and how effectively it drives risk. And artificial low volatility, it's a little bit like I always use the example of driving a car at 300 miles or 200 miles an hour when the speedometer says 80, right? If you crashed, what are you going to feel? And the fact is you'll feel the real speed you had, not what the speedometer said. And implied volatility is a little bit like that. You could have artificially low levels of volatility, but eventually when things happen, these levels of volatility could explode, and they create a very mechanical process. I look at the VIX around 40 at a level where things really shift from a more laminar regime to a more chaotic regime, if we were to use the analogy of fluid mechanics. And basically this process of higher volatility, forced liquidation that starts to impact liquidity, also leads to polarized correlations, which effectively create this vicious compounded effect into higher volatility, liquidity, etc. As a result, you get things get out of control, risk metrics explode exponentially, and you get a situation that feeds back and is very difficult to control. And that's why central banks are very aware of this, and they will do whatever it takes to prevent these things from getting out of control as they should. We see this idea of bubble anti-bubble very clearly in this graph, where it's a bit of a reflexive situation where prices impact volatility, but volatility also impacts prices, and how during pretty much every single crisis by construction you get to see these big moves up in vol. It's also true that when volatility is very low, even artificially low, I would argue, this can contribute to the opposite, to melt up situations. And this is something that is risky because there are lots of strategies that are systematic, such as trend followers or risk parity or volatility targeting, that effectively as the volatility goes down, they buy more, and they end up accumulating their largest positions at the top with artificial low levels and too high leverage, which effectively unwinds when things reverse. The challenge for those who want to acquire insurance is, if you look at something like the VIX, is the carry, is the cost of this insurance. And what you see here in white and blue, in white is the index as you see it in your screen. In blue is what you get in your pocket. And basically what you see is that the cost of being along this insurance and rolling these futures over time has created an incredibly negative drag. So we're talking about an 86% capital loss since we launched Igneo in just to keep the time horizons the same, which gives you it's in stark contrast to the appreciation of the VIX itself. So you see that the VIX up 20%, your pocket down 86%. And this is really due to this term structure, this risk premium, where which can be understood a bit easily when we look at this. What you see is snapshots of the volatility term structure, so the futures of the VIX through different periods in time. And the first one on the left in the green box shows you the middle of the crisis in the pandemic. So risk aversion exploded, but the market was expecting this to be short-lived and things would normalize, which they eventually did. These big shocks effectively lead to people to want to own insurance just in case these things happen. But this contango, buying expensive, selling cheap, has been as steep as -% per month. So if you do this for a prolonged period of time, you see a very large destruction of capital. We saw with Omicron a short episode where volatility went into backwardation. And this is generally a very, very strong signal, both for commodity markets as well as volatility, that something big is happening. It was, however, extremely short-lived. And in fact, the sell-off was pretty vicious. You see the steepness in the VIX curve selling off to close to 15 in the follow-up, which contributed to the melt-up. So effectively, trading the VIX is tricky. Timing matters, and you need to find for ways perhaps that will allow you to protect your capital rather than just continue to just roll the futures. And so when you think about the options market and what it tells us, you see here one expression. You see in red the money vol for a 1 month option is roughly about 108%, which is pretty high. But you also see that when you look at higher strikes towards the bottom, you see, for example, 45 call on the VIX, even if it's very, very far away with the the index around 21 is more than double. It's still worth about 60 cents, and this is reflective of implied volatility of around 168, which is pretty significant increase relative to the at the money, and it's something that, of course, is driven by risk premia, an imbalance in supply and demand. Nobody wants to be short those things when hell breaks out, and this is something that is a double-edged sword, because effectively can give us it's a problem if you want to buy that sort of insurance. It's an opportunity if you want to create things like call spreads, where you buy the lower strike and sell the other, because you get to monetize that huge skew and reduce the carry. We've been doing that through the past year. We've been buying call spreads with very attractive payoffs, 10 to 1, 20 to 1. However, we know what happened. The market was pretty much one way, didn't have any meaningful risk-off event that gave us the opportunity to monetize some of this. And as a result, a lot of that insurance was expired worthless. The book has been rolling positions and has more longer dated positions as well. But nevertheless, this is something to be mindful, whether the options you buy are cheap or expensive. If they don't pay over a considerable period of time, it becomes very, very painful. What you see here is effectively the same information, just expressed in a 3D form, with snapshots of the term structure, the volatility, and the massive, effectively cold skew that you see, and the term structure where of these markets. If you think about a little bit sort of the mirror image of the VIX, at the end of the day, the VIX is in itself is volatility. So the previous graph shows the vol of vol, is the volatility of the volatility. What we see here is the volatility itself, is the actual vol surface for the S&P. This is obviously a much lower level of vol. and you see a different term structure with the market perhaps willing to sell this insurance cheaper for shorter dates, and also the mirror image of that call skew in the VIX is effectively a put skew on the S&P, as we see on the bottom right, which is something we take advantage of through strategies that effectively give us insurance at current levels by giving up some of the downside in the event of large sell-offs. This is technical, but it gives us directionally the kind of insurance we want against lower prices. It puts us net long volatility, although effectively we're short that tail at the bottom. And very interestingly and importantly, in a scenario where the market goes our way, you basically have very positive carry at lower prices until you might hit the barrier. We've favored European barriers so that even if you cross that barrier throughout the life, you're still in play, because what we tend to do is do these barriers only at expiry. So you ensure in a way that you're protecting a lot of that value. If you look at the situation for other markets such as gold, here very, very different. We see a much more normal volatility smile, where effectively the market is telling you that gold does not follow a log normal distribution, surprise, surprise, and whereby the implied probability of a very big move up and very big move down is greater than predicted by the log normal. So you have these fat tails on both ends, which are pretty symmetrical, and this is something that, combined with the contango in the futures and the contango in the vol term structure, as you can see in the graph at the top right, is something that we do take advantage also to introduce strategies that are both vanilla, but also with this sort of profile that seeks to monetize this skewness, and that gives us, in our opinion, a better risk-adjusted return by reducing the premium, improving the carry, and enhancing the asymmetry. When we look at other markets such as the Chinese yuan, this is a very strange looking, maybe, or very different. What is most shocking here is the extraordinarily low level of implied volatility. Remember, we're looking at levels, in the teens for gold, in the low 20s for the S&P, in the hundreds. We're looking at the Chinese yuan in the short dates around, sub 3%, which is telling you this doesn't move at all. This is the standard deviation of the distribution, and it is consistent with what's been happening recently with the rear mirror. It may not be consistent with the actual risk ahead, and that's something that the market is pricing. You see how the big contango in as you go out, which is both in the forwards as well as the volatility, and also in the skewness, where the market is much more nervous about a big breakout of massive devaluation of the yuan than a big appreciation. And here, if you think about proxies as well as an alternative to cheapen things, we've been quite keen on the Taiwan dollar. I mean, they've moved, as you can see, both lines in blue, with very close correlations. I mean, very similar paths. Despite the price action in the dollar, you've seen China totally relentless. I mean, doing extraordinarily well. And we think this offers attractive entry points for strategies that are effectively long gold, short the yuan. And this could be done both through the yuan as well as the Taiwan dollar, also in combination with moves in interest rates, which take advantage of the roll down and the carry on rates. but also in terms of correlation. There's some examples where we have these strategies where instead of just protecting against one event, we're adding two of them. And when the market's implied view on correlation is they will move in parallel, you might get very significant or very attractive discounts by monetizing this. So strategies like dual digitals or worst offs is something that we own in meaningful size. They are very cheap and they will only pay if both conditions are met. They're cheap for a reason, and the most likely thing is they will not pay. But if they do, which could happen in periods like crisis, then it's extraordinarily asymmetric. So with very large payouts. So with that, I conclude this section. I hope you found it helpful, and invite you to join us for other sections where we'll be discussing the macro outlook across a number of key drivers. So with that, thank you again, and speak soon.